Most people spend decades building up three things: a pension pot, some savings, and the family home. And most people, if they're honest, have never stopped to ask a straightforward question: if you needed care tomorrow, which of those three would the council be allowed to count? Because the answer is not what most people assume. And by the time they find out, it's usually too late to do anything about it. So stay with me, because what I'm going to cover in the next few minutes is not scare tactics. It's the actual rulebook, how the means test for care fees works, what's changed with pensions, and three assets worth thinking about before the options start closing down. Quick note before we go further: everything I'm covering is general information to help you understand how the rules work, not personal financial, tax, or legal advice. Your own situation is different from the next person's. For anything that affects your own money, check the official guidance at gov.uk or speak to a regulated advisor. There are free services for that, and I'll point you to them. If you're enjoying this so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. Let's start with the test itself, because you can't plan around something you don't understand. When a local authority in England assesses whether you qualify for help with care home fees, they carry out a financial means test. In 2026 to 2027, the upper capital threshold is £23,250. Above that figure, you're expected to fund your own care in full. Below a lower threshold of £14,250, your capital is largely disregarded and the council takes over. Between those two figures, you pay a sliding scale contribution. The council looks at your savings, investments, and this is the bit that catches people: your property, unless a qualifying relative still lives there. Those thresholds have not changed since 2010. The cost of residential care, by contrast, has not stood still. Average fees in England in 2025 ran to around £1,400 a week for standard residential care. That is over £70,000 a year. The mismatch between frozen thresholds and rising costs is one reason this matters so much for anyone now in their 60s or early 70s. The council is also allowed to look backward. If they believe you transferred, gifted, or moved assets specifically to reduce what you'd be assessed as owning, they can treat you as if you still own those assets. That's called deliberate deprivation of assets. And here is the thing that almost nobody gets right: there is no time limit on how far back they can look. The 7-year rule that applies to inheritance tax gifts has no equivalent here. A council can review a transfer made 20 years ago if it concluded that avoiding care costs was a significant part of your motivation at the time. The question they ask is not how long ago you did it. The question is what was in your mind when you did it, and whether needing care was something a reasonable person in your position might have foreseen. That last point is important because it's actually more protective than people realize. A transfer made in your early 60s when you were fit, working, and not unwell is very different from one made in your late 70s after a health event. The former is much harder for a council to challenge successfully because the evidence of foreseeability is thin. The latter is far more vulnerable, which is one of the reasons why timing and doing things early for legitimate family reasons matters so much. With that foundation in place, let's go through the three assets and what's actually worth knowing about each of them. The first is the pension. For years, unused pension funds sat entirely outside the inheritance tax net. A defined contribution pension, the kind where there's a pot of money with your name on it, a SIP or a workplace DC scheme, could be passed on to your beneficiaries free of inheritance tax, regardless of the size of the pot. That made pension funds attractive not just as retirement savings, but as a way of passing wealth down to the next generation. A lot of people quietly built that into their planning. From the 6th of April 2027, that changes. The Finance Act 2026 received royal assent in March of this year, and it brings most unused pension funds and pension death benefits within the estate for inheritance tax purposes. So from that date, if you die with money still sitting in a defined contribution pension, that pot gets added to the rest of your estate. If the total comes out above the nil rate band, currently £325,000, the excess is taxed at 40%. For a married couple leaving the family home to children, the combined allowances can reach £1 million in the right circumstances, but the pension change means that people who previously sat comfortably under the threshold may now find themselves over it. The government estimates that around 10,500 estates will face an inheritance tax bill for the first time because of this change. A further 38,500 already in the tax net will pay more. Defined benefit pensions, the old style final salary schemes that pay a guaranteed income, are largely unaffected because they don't leave a transferable pot. It's the defined contribution world where this bites. Now, the obvious reaction is to start drawing down the pension quickly before April 2027. That instinct needs to be handled carefully. If you take a large lump sum from a pension in a single tax year, most of it will be taxed as income at your marginal rate 40% or 45% for anyone in the higher bands. And the money then sits in your estate, potentially subject to inheritance tax anyway. You've moved it from one taxable pool to another and paid income tax on the way. That's not a plan. That's an expensive accident. The more considered approach is a gradual drawdown at a pace that uses the lower income tax bands, drawing an amount each year that keeps you within the basic rate band rather than triggering the higher. Over several years, that compounds into a meaningful difference. The money that comes out can go into gifts using the normal annual gifting allowances or into expenditure patterns that qualify as regular gifts out of surplus income, a route I'll come back to. The other thing worth knowing about this is that pensions are passed on by expression of wish, not by your will. Your will has no legal authority over a pension. The trustees of the pension scheme have discretion over who receives the money, and your expression of wish form is what guides them. If you haven't updated that form in years, if it still names a former spouse, or it doesn't name the right people, the money may not end up where you intended. Updating your expression of wish costs nothing and takes a few minutes. It's worth doing this year, regardless of everything else. The second asset is savings and investments, including ISAs. People assume ISAs are always protected. The tax wrapper that shields the returns is real and valuable during your lifetime, but the ISA wrapper is irrelevant to a care fees, means test, or to inheritance tax when you die. The underlying money is still your capital. If you hold £60,000 in a cash ISA, the council counts £60,000 of capital in the means test. If you die with £60,000 in a stocks and shares ISA, it sits in your estate and is potentially subject to inheritance tax at 40% above the threshold. The gifting rules around savings are the key tool here, and they're underused. Each tax year, you can give away £3,000 free of inheritance tax immediately without any 7-year wait. That's called the annual exemption. Unused portions from the previous year can be carried forward 1 year. Small gifts of up to £250 to any number of people per year are also immediately exempt. Those are the well-known ones. The less used one, and it's genuinely powerful for people whose regular income exceeds what they spend, is the normal expenditure out of income exemption. If you make gifts regularly from surplus income and they don't reduce your own standard of living, those gifts fall outside your estate immediately. No 7-year wait. There's no upper limit on the size of the gifts as long as they come from income rather than capital and they genuinely don't affect how you live. You need to document it, a simple record of what you've given, when, and that it came from income, but it's one of the most tax efficient gifting routes available, and the majority of people who qualify for it never use it. For care fees purposes, the same principle applies as before. Gifts made well in advance for genuine family reasons, when you were in good health and care was not foreseeable, are in a fundamentally different position from last minute transfers. There's no magic number, it's motivation and foreseeability that the council weighs. One more point on savings. If your capital is currently above the upper threshold of £23,250 and you're in or approaching the years where care might become relevant, it's worth checking whether your expenditure patterns, holidays, home improvements, helping grandchildren are documented. Ordinary spending is not deprivation. A council cannot penalise you for spending your own money on your own life. The issue arises when the council believes a transfer was motivated by care fee avoidance rather than something else. Documented, ordinary, normal spending is not that. If you're finding this useful, subscribe and turn on notifications so you don't miss the next one. I cover all of this in plain English so you don't have to wade through 40 pages of gov.uk yourself. The third asset is the family home. The home is the asset that generates the most panic and therefore the most bad decisions. Two things are worth separating clearly: care fees and inheritance tax, because the rules are different, and conflating them is what leads people to do things that fail on both counts simultaneously. For care fees, if you move permanently into residential care, your home is generally included in the financial assessment, unless your spouse or civil partner still lives there, or in some circumstances, a qualifying relative such as an incapacitated relative or a sibling who has lived there for at least a year. A dependent child does not automatically trigger an exemption in the standard means test. The home's value is counted, and you'll be expected to fund care from it if you're above the threshold. For inheritance tax, the home sits in your estate. A single person can pass on £325,000 before the 40% rate applies. If you're leaving the family home to your children or grandchildren, there's an additional residence nil rate band of £175,000, bringing the potential threshold for a single person to £500,000. For a couple, where the first to die leaves everything to the surviving spouse, who inherits the unused allowances, the combined threshold in the right circumstances can reach £1 million. Many families, particularly outside London and the South East, don't have an inheritance tax problem once you do the sums properly. Before worrying about the home at all, it's worth calculating whether there's actually a bill, because a large number of families who come to this question find there isn't one. Now, the response many people reach for when they think there is a problem is to sign the house over to the children. The older reference videos for this channel cover this in depth, but the short version is worth repeating. If you give the house away but carry on living in it rent-free, HMRC has a rule called gift with reservation of benefit. Under that rule, the house is treated as still yours for inheritance tax purposes because you kept the benefit. The transfer achieved nothing for inheritance tax, but you've lost control of the property entirely. It can end up exposed to your children's divorces, creditors, or financial difficulties. And for care fees, a council that decides you gave the house away specifically to reduce care costs can treat you as if you still own it anyway, with no time limit on looking backward. So you can end up with all of the downsides: no tax saving, no care fee saving, and no control. There are legitimate structures, tenants in common arrangements combined with mirror wills and will trusts that can play a useful role in protecting one partner's share of a property from being fully swept into a care assessment when the surviving partner moves into care. These are not workarounds or loopholes, they're the application of standard property and trust law for the purpose they were designed for. But they need to be set up properly with legal advice when there's no immediate care need on the horizon. Once care is already foreseeable, the window for legitimate planning narrows considerably. The action steps from all of this sit in a straightforward order. First, check your pension expression of wish form. Contact your pension provider or scheme and update it if it's out of date or doesn't reflect your current wishes. This one is free and takes minutes. Second, if you're not already drawing from your pension, speak to a regulated financial advisor about a sustainable drawdown strategy before April 2027. The goal is not to strip the pension out in a panic, but to draw down at a pace and in tax years where the income tax cost is manageable. Third, check whether you currently use the annual gifting exemption, £3,000 per year, immediately outside your estate. If you didn't use it last year, you can carry that 1 year forward, meaning a couple could give away £12,000 this tax year without any 7 year requirement. Money Helper at moneyhelper.org.uk has plain English guidance on gifting rules. Fourth, if you have more income than you spend regularly, ask an advisor whether the normal expenditure out of income exemption applies to you. It's the most powerful and least used gifting route in the rules. Fifth, if you're a homeowner and you're interested in what tenants in common arrangements might achieve for your situation, Citizens Advice can offer initial guidance, and a solicitor with experience in estate planning can advise on whether it's appropriate. PensionWise at moneyhelper.org.uk also offers free, impartial guidance on pension decisions for anyone over 50. The common mistake across all three of these assets is waiting until something has already gone wrong or acting in a panic when care is suddenly in view. By that point, almost every useful option has either closed or is vulnerable to challenge. The planning that holds up is the planning done early for documented, legitimate family reasons when care was a distant possibility rather than an immediate one. Let's pull this together. 3 assets, 3 different sets of rules. The pension, from April 2027, unused defined contribution pots fall into the estate for inheritance tax. The answer is not a panicked full drawdown. It's a considered gradual strategy using your lower rate tax bands over time, updating your expression of wish now, and taking regulated advice on timing. Savings and ISAs. The wrapper protects the growth, not the capital, from inheritance tax or care fees. The gifting rules annual exemptions, normal expenditure out of income, are the legitimate tools, and they work best when used consistently and documented properly over years rather than deployed in a rush. The home, giving it away, doesn't reliably protect it from either inheritance tax or care fees if you carry on living in it. The structures that can genuinely help are those set up correctly with legal advice well before care need is in sight. The thread running through all 3 is the same. Early, deliberate, well documented action is what holds up. Late, panicked action is what costs families the most. A reminder before you go: everything here is general information, not personal advice for your situation. Rules change, these ones have changed within the last couple of years. Please check the latest guidance at gov.uk or use the free services at Money Helper, PensionWise, or Citizens Advice before you do anything material. One last thing before you close this tab, and I'll keep it short. A lot of people watch something like this, nod along, and then do nothing, not because they don't care, but because the next step feels large and the day fills up quickly. So let me make the next step as small as possible. You don't need a solicitor today. You don't need to call your pension provider this afternoon. You need to do one thing: write down the three assets: pension, savings, home. Next to each one, write what you actually know about how it's currently set up, who's named on the expression of wish, whether you've used your gifting allowance this tax year, whether your home is owned jointly or as tenants in common. That piece of paper or the note on your phone is the beginning of a proper conversation with an advisor, a solicitor, or even just a family member you trust. It puts you ahead of the overwhelming majority of people who arrive at their late 70s having never asked these questions at all. The rules are what they are. You can't change them. What you can change is how prepared you are when they apply to you. Free guidance is available now at moneyhelper.org.uk and pensionwise.gov.uk. Both are impartial, both are staffed by real people, and both are entirely free to use. Thank you so much for watching until the end. If you found this helpful, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next one.